Imagine watching your hard-earned savings evaporate overnight, your home value plummet, and your financial future thrown into turmoil. The 2008 housing bubble and the following economic crisis wreaked havoc on millions of lives, leaving us to wonder, how did this happen? And how can we avoid this happening again? Today, by exploring three schools of economic theory, the Chicago School, the Keynesian School, and the Austrian School of economic thought, we're going to power and unravel the complexities of this economic disaster. And as we delve into the principles of R. Nelson Nash and the infinite banking, we're going to uncover a powerful strategy that can safeguard future generations from similar disaster, ensuring lasting financial prosperity. Who's ready to learn how to protect our financial future by looking at the past first? A wise man once said, the problem in America isn't what people don't know, it's what people think they know that just ain't so. By Will Rogers. And ain't that the truth, folks? The global financial crisis of 2008 stands as a watershed moment in our economic history. It left an enduring impact on our global financial systems, and it shaped economic policy for years to come, and it's still shaping it today. The crisis was triggered by a collapse of the housing bubble, exposed underlying vulnerabilities in the global economy, and led to widespread instability. The 2008 crisis, let's look at this in a positive light. Let's look at this complex phenomenon in a way that was shaped by a confluence of factors well beyond most people's understanding. But these include excessive risk-taking in the financial sector, lax regulatory oversight, and a surge in subprime mortgages. The behavior of people around money. It's pretty logical stuff. And the crisis serves and gives us a blueprint of what not to do in the future. And as we go through this this inflated period of time where everything seems to get more and more expensive, how can we take back control? So let's dive into this. Let's look at each school and really figure out how can we have more financial stability in the future and take back control of our monetary system. Let's go through the Chicago School of Economics first. The Chicago School core beliefs is that there should be a free market with no government, intervention, laissez-faire, meaning leaving things to their own course. And the most famous of all Chicago economists was Milton Friedman. And it's based out of Chicago, and that's kind of where the name comes from. And we're going to go through, this is what the Chicago theory, the Chicago School of Thought believes. And we're going to show how they point to anytime there's a problem in the economy, they either look at some kind of government intervention or some kind of government law that was passed that's causing unnecessary stress or unnecessary things to happen in the market. So when we go back and we look at the 2008 housing crisis, they believe that the first thing we want to look at is kind of the Bush administration and saying, hey, this is homeowning is something that all Americans want. We want to have a United States of America where everyone can afford to own a home. And so there was tax benefits in place that made people believe that, hey, well, when I invest money in a home, I'm given an advantage over renting or any other investment because I have a tax write-off. They incentivize people that maybe couldn't afford homes or weren't going to buy homes, but through the policies, the Chicago School believed that, hey, it encouraged people to buy more homes. And then you have to look at the Community Reinvestment Act, which was another part of the problem that had commercial banks were encouraged to make loans to minority groups that otherwise wouldn't have qualified to avoid fines. So now we have commercial banks all over the country giving out loans to folks who weren't on paper qualified, who, whether it was their income or their debt to income ratio weren't qualified for these loans. And then you throw in the next piece of the puzzle, which was Freddie Mac and Fannie Mae, who, if you look at their mission statement is to make homeowning a reality for those who can't afford it. Think about that. Their mission statement is to make homeowning a reality for those that can't afford it. And so this had financial institutions taken on excessive leverage, taking on loans and mortgages that people really couldn't afford, and then offloading them to Freddie and Fannie in the secondary market. And the Chicago School contends that these government-backed mortgage programs created an artificial demand for housing, driving up prices, like leading to inflated prices and an unstable level of borrowing. And even though they were designed with good intention to promote home ownership, then you have other things that happen at the same time. You had the mortgage-backed securities, and you had all of these other derivative markets that were created because the institutions ran all of these financial models using PhD scholars and other Ivy League scholars to create these models saying, hey, well, it's safe. If we're taking different mortgages from different parts of the country and putting it into one asset class, we're protected because you can't have Tampa and Chicago and San Francisco and every other state in the country fail simultaneously. It's just impossible. That the probability is so high. But man, were they wrong. Overall, the Chicago School said, well, hey, the Federal Reserve's loose monetary policy, the low interest rates, the abundant liquidity, and it played that role in inflating the housing bubble. And this created an environment where borrowing was cheap, accessible for people that otherwise couldn't afford it. And it led to an increase in subprime mortgages, sustainable levels of debt, which eventually led to the crisis. Now, if we look at the Keynesian School, the Keynesian School is made famous by John Maynard Keynes, and he's famous for the book, I believe in 1936, called The General Theory. And Keynes focused on aggregate demand. And aggregate demand just means the total amount of spending on domestic goods and services in the economy. So it doesn't look at one specific thing. It's just looking at the general numbers, a general amount of things, of money in the government and that we're spending in our economy. And it also believes, the Keynesian School believes, like, hey, we kind of believe in free market, but when the market isn't performing the way we thought it was going to perform, then what we'll do is we're just going to borrow more money and inject that capital into the system. We're going to stimulate growth. We're going to show people that, hey, inflation is down, the market is low, it's time, it's okay to go spend money. It's okay to go be an entrepreneur and create new goods and services and hire people, which drives up, drives up employment. And so this is what the Keynesians look like. They practice what's called counter-cyclical intervention. They believe that this cutting of this interest rates will stimulate spending and the business growth. And so let's look at what they thought about 2008. Like, what were some of their key points in explaining why, the free market isn't good. It's really about the government stepping in when needed to make sure that it's propping up the economy to give prosperity. And so, one of the key points that the Keynesians made was, well, hey, Alan Greenspan came out and admitted that he overestimated capitalism's ability to self-regulate. He believed that entrepreneurs and investors, especially investment bankers, cared more about their money than the government did. And the Keynesians, in their mind, they thought, well, hey, Alan Greenspan just admitted in front of the whole world, the whole country, that the Fed could have jumped in. The Fed could have jumped in and helped. So, hey, that supports our theory that federal regulation, federal involvement is a good thing. And the Keynesian theory emphasizes the demand of the shock in the economy. The shock led to a sharp fall in the aggregate demand. That resulted in the vicious cycle of reduced production, job losses, and further spending cuts, which means what? Well, because of this trap, we have to put money back into the system. We have to promote the growth, right? And it talks about how the reckless lending and the greed of the investment bankers really created this housing bubble and the subsequent bust. And so then we're going to go to the third school, which I believe, we're giving painting a fair picture of each school and their theories, because these are some really, really of the best and the brightest thinkers on monetary policy in the world ever, right? And so now we're going to look at the Austrian school. The Austrian school started back in the late 1870s with Menger's Principles of Economics, right? And it supports free market, sounds familiar, like the Chicago School, without government invention. And then the most famous of all the Austrian economists is Hayek. He won the Nobel Prize for his Austrian business cycle that was published in the 1970s. And the Austrians believe that it's the people, the households, that drive the economy. We decide, they believe that you can't look at the aggregate number because not all machines are created equal. You can't say, well, what's in this sector and this sector of the economy are equal, because they're not. They say, well, people are the ones driving the demand, right? Supply and demand, and the people set the price. The people show us by what they spend their money on what is the right amount of interest to have on that. What is the right amount of inflation? They believe that inflation is driven by the decisions of the people. And again, they believe the machines aren't interchangeable. The capital is not just a number, and the prices and inflation mean something. Now, to me, this lends itself to, the law of physics, where energy can't be created nor destroyed, right? A thing in motion tends to stay in motion. So imagine, and I'll go in a second, kind of the Austrian beliefs and why there was the bubble, housing bubble, and the crash. But the Austrians believe that, hey, what happens if everybody in the community, imagine everybody in your state or everybody in your circle decide we're going to save, like we did during the pandemic, and then some. We're going to save for future amazing trips. We're going to save for a rainy day. We're going to save for our kids' college funds. We're going to save for that next car that we've had our eye on for years, that convertible, whatever the thing is. But we're not going to get it now. We're going to practice some discipline. We're going to save for later. Well, what would happen if people stopped going out, going to the movies, eating out, doing different things? Those sectors would shrink. People would lose jobs, things would close, it would self-regulate, because now other entrepreneurs, other demands would be there for future things that people are going to buy and want and need. And the market kind of controls it. It's kind of like how money was created. It's a means of exchange. That's all money is. That's all. It's just value, right? That we're just exchanging value. It's a store of value. And so when we look at what the Austrians believed, what was the reasons for the housing bubble and then the following crisis, and how can we avoid that from happening again? Like I said, number one is they don't believe that you can inject just printed money, artificially low interest rates. It stimulates, that gives a false sense of security to people. It shows people like, hey, you know what? The economy is okay right now. It's okay to go spend money. It's okay to live for today. It's okay to start a new business, to hire people, to grow, because look, inflation rates are so low. But when they're created not by demand, when they're created by government intervention, the Austrians believe, though, this can't be good, because this is going to lead to the boom and the bust cycle, which is what we're talking about today. Like, what's coming next for us? Is it going to be a recession? Is it going to be another boom where it was 10, 12 years where the market's going up and up and up and up and up, and then it comes back? Because every time, if you're practicing Keynesian theories, you're injecting the money, and the Austrians are saying, wait a minute, you can't do that, because it's really the households, the people, who drive this. And then they look at the bad investments or the malinvestments. One of the things I was researching today is, well, look, pre-pandemic, there was, 2+ million cars available, new cars available. And then during the pandemic, we know what happened with supply chain and everything else. And it's been impossible for the last couple of years to get a new vehicle. Prices have skyrocketed, inflation has skyrocketed. But now today, if you look this up, there's 2.77 million new cars, which is higher than pre-pandemic numbers available. And so now there's all this demand and people don't really want it and it's just sitting there. You just have these pieces, these cars, this metal used for making more cars than we currently need versus kind of matching our need for something. And so these investments aren't necessarily the best because now what's going to happen? That's going to shrink back down to match our demand. And it's an inevitable correction. And so the Austrian concept on what happens during a recession is there's no intervention. It will work itself out. People will make the market correct itself by what they want, what they're going to spend their money on. And that's the power we have. And that's where we're going to bring in R. Nelson Nash, who started practicing and studying the Austrian economist back in 1956. And he didn't bring us the infinite banking concept to the 80s. So while the Chicago School, the Keenen School, Austrian schools offer valuable insights to the 2008 financial housing bubble and the crisis that followed, this comprehensive understanding of what economic prosperity looks like requires us to look beyond these traditional theories. It shows us, like I was mentioning, that Nelson Nash started studying this back in the early 50s or in the mid 50s, and he developed the infinite banking concept because he started seeing what is really happening in our economy. What is our money really backed by? Remember, we came off the gold standard in the 70s. Our money is just a fiat system, just fiat money, just meaning paper money. It's like monopoly money. When we need more, our government believes we can print more and just put it in, and it creates, this false sense of security. And Nelson decided, like, okay, well, how do we take back control of the interest? How can we, as a people, have an innovative approach to our financial and wealth building? And that's where the infinite banking concept comes into play. This infinite banking concept, we talk about it all the time here on Founding Fathers. This is our path to financial freedom. This is the bedrock of how we build, keep, and create more wealth. It empowers people to take back control of their finances by changing just one thing. We're just changing where does the money go first, and we're taking back the what? The functions of the banking system. We're taking back functions of banking in our personal lives, and this gives us the ability to control interest. It gives us the ability to pay ourselves the interest. When we look at the typical American right now, 35 cents of every dollar is going out the door and being paid to somebody else's family, to the people who own the banks, work at the banks, run the banks, not your family. So the Austrian school believes in sound money principles where the dollar has to be backed by something. You just can't print it on a whim and throw it into the market and say, hey, look, everything's fine. Like, if you think about it, that's a little bit absurd. It's a little bit crazy in my mind. Yes, I'm still learning how to work through these, and I don't have my PhD as an economist. I'm just teaching you guys the basics of what happened and how can we avoid it for the future. And the infinite banking concept provides this framework. It's a systematic way to build wealth, of wealth accumulation. It encourages individuals to use the specially engineered whole life policies with these mutually owned, dividend paying whole life companies. And we work with multiple companies because why? Because they all serve different purposes for different people. We don't want to try to fit something into like a square peg into a round hole. We don't want to try to fit something into something that doesn't work. We want to be able to bring people a way to build a sound financial future. And this means that our dollars are going to be backed by something. Whatever your cash value is in your policy is what you can borrow against. So it's the principle that a dollar is backing a dollar versus, our current banking system where you put a dollar in and now you can lend out 10. It's so this is the way that, again, we're going to build, keep, and create more wealth, and we're going to protect our future generations. Understand the complexities of the 2008 financial crisis through the lens of the Chicago School, the Keenen School, and the Austrian School equips us, the people, and our families with a multifaceted perspective on economic stability. The Chicago School emphasizes the dangers of government intervention, loose monetary policy, and while the Keynesians, they showed us that, hey, aggregate demand and the need for government intervention in times of crisis might not be the way forward, while the Austrian School shows us and stresses the importance of sound monetary policy and the perils of unstable, unsustainable economic booms fueled by artificially, the word artificially is the most important, low interest rates. And so the infinite banking concept is giving us a practical framework. Just remember, it's simple as simple, a practical framework to build our financial resilience, to achieve long-term prosperity, and to provide us with a tool, a powerful tool for navigating the complexities of the modern economic structure. Today, we went on a journey together. I wanted to show you what I'm studying with infinite banking and how these different schools of thought, so you can make your own perspective, so you could decide and empower yourself. And by embracing this wisdom, you're already doing what most people won't do. You're already doing what 95% of Americans won't do. You're going and being curious and learning, how can you change your financial future? How can you break old patterns by looking at what happened historically, taking these economic theories and implementing principles of responsible financial management? Together with this, we can chart a course toward a more stable and prosperous future. It safeguards our financial well-being and navigates the inevitable economic cycles that shape the world's landscapes. We can have this grassroots movement make changes that we can't even imagine what they're going to look like in the future. But remember, the first principle of infinite banking concept, as taught to us by R. Nelson Nash, was what? Think long term. Think multi-generationally. How can we do what the Rockefellers and the Rothschilds, Morgans and Stanleys have done? Walt Disney. We can do it by just changing one thing. And this leads us to your next steps. Today, we delved into the different schools of thought around the 2008 housing bubble and the subsequent crash, the financial crisis that left so many Americans just in a awful state, financial state, just in financial crisis. How can we learn from these schools of thought? How can we learn from Austrian economics and take back control of our money? Again, I appreciate you being here today. If you're new here, make sure you subscribe, you smash the like button, and you ring the bell, because it might just turn blue and it'll alert you to all of the new content that is going to come out on a weekly basis. And if you're wanting to know more about the infinite banking concept, watch this video here and go ahead and pop your questions in the chat and below. I want to hear from you. I want to know what questions you have, and I want to support you on your journey of infinite banking. Again, I'll see you in the next video here. So check this out. Appreciate you. Be well. See you in the next video. Be blessed.